Hi, my name is Siddiq Desha, Chief Investment Officer for Sun Life Global Investments. As we begin to settle into a new normal, the markets are still showing a lot of uncertainty. In March, we saw the CBOE volatility index levels go above 80, about 4 times the long-term average. Heading into June, the VIX has settled into the 20s and 30s, still significantly above normal, but for now, down from the extreme. As we move into the next phases of the pandemic, we continue to manage risk while looking for opportunities for longer-term growth. Join us as we present our Quick Take series. At Sun Life Global Investments, we go through a rigorous process to select and monitor sub-advisors from around the world. In our Quick Takes conversations, they provide important insights into their regions or asset classes. We hope that this diverse coverage will help you manage and stay informed through this period.
Hello, thank you for joining us today as we speak with investment specialist Peter Longto to discuss the Sun Life MFS Global Growth Fund. Peter, how has the asset class been impacted by the recent market events?
The market impact of the coronavirus has been the dominant market story of 2020, as efforts to slow the spread of the virus brought economic activity to a halt in many industries and led to sharp declines in employment and economic growth across the world. Before markets rebounded sharply, global equities fell over 30% in local currency terms, as measured by the MSCI World Index. The speed of the fall was unprecedented, and volatility hit record levels. Encouragement about the response from central banks and policymakers, combined with optimism about a potential vaccine or therapeutic, have underpinned a swift rebound in equities, with the MSCI World Index now down about 5% through the 22nd of June, and perhaps more relevant to our discussion about the Global Growth Fund, the MSCI All-Country World Growth Index is now in positive territory for the year-to-date period, up 7% through June 22nd in local currency terms. Just amazing to think that the broad index on the growth side could be in positive territory given everything we've been through for the year-to-date period. Spending patterns by consumers and businesses have changed dramatically in response to the new environment. It is notable in the context of global growth equities that many of the companies that were the largest in our index had business models that it turned out they were ideally suited to the changed behaviors resulting from the shutdowns. Trends like working from home, increases in cloud-based computing, and e-commerce. Many of these stocks had high valuations entering the year and have subsequently outperformed the overall market, leading to an even wider valuation gap between some of the largest high-growth stocks in the index and the rest of the stocks in the index.
Are there any sectors or regions where there could be opportunities given the recent market events or sell-off?
Our focus and priority once the market sell-off began was on re-evaluating stocks, conducting deeper scenario analysis and stress testing downside models with detailed scrutiny of balance sheets, liquidity, debt repayment schedules, and financial risk. Our long-standing structure of having credit analysts integrated into our sector teams was incredibly valuable to do that work. And as a result of that work, we added to some of our more defensive positions that we viewed as attractively valued relative to their long-term growth potential and whose business models we believed would not be structurally impaired by the COVID-19 crisis. An example is a medical device company which makes implants used in joint replacement and trauma surgeries. Although elective procedures were postponed as hospitals focused all their efforts on the COVID-19 crisis, we believed these procedures would eventually take place and the long-term demand for this company's products would not be structurally impaired. Another area where we actually added a couple of new stocks is companies that provide outsourced research and development and commercialization services to the pharmaceutical, biotech, and medical device industries. We like this industry for its exposure to drug discovery growth, the ongoing trend towards outsourcing R&D, and because these companies provide a core specialized service where cost is not the number one priority for their customers. We believe their revenues should be relatively acyclical, and drug trials should recover quickly after COVID-19 lockdowns end.
Have there been any changes to the fund based on your view?
From a big picture perspective, there have not been significant changes, no major reshuffling or rebalancing, and certainly no changes to our investment approach, which uses a long-term view to focus on high-quality, durable businesses trading at reasonable valuations. I will circle back to my earlier comments about the leadership of some of the growth stocks that have been big positions in the Global Growth Index. Our portfolio has been underexposed to the fairly narrow group of higher valued growth names that have been leading the market higher. And that can make it challenging to keep up with the indexes when the market is crowding into these stocks. We wanted to keep the underweight from continuously expanding and becoming a more significant driver of relative returns. So at the end of May, we made a handful of trades to increase our exposure to key secular growth trends like cloud computing, e-commerce, and electronic payments, while still trying to stay true to our valuation-sensitive, growth at a reasonable price style. These trades include adds to a reasonably valued U.S. company that provides software and cloud services, a Chinese leader in e-commerce that also has strong cloud and payments businesses, and a new position in another Chinese company that we expect to deliver strong growth from advertising, payments, and the cloud.
Thank you for your time, Peter.